Good afternoon, traders. Hello there. Welcome to the next in Admirals Trading Spotlight webinar series. And here today, what we're going to do is be talking about candlesticks for beginners. So the clue's in the name, but we'll be looking at Japanese candlesticks, and in particular with an emphasis on how to help a complete beginner in terms of understanding them and how to utilize them. If you're joining us here today for the session, it's great to have you here. You're very welcome. If you're watching this later on the Admirals YouTube channel, well, I hope it helps you in your own trading journey. Be sure to subscribe, to the channel, and make sure give us a thumbs up if you found it helpful, or even a thumbs down. We don't mind. All feedback is welcome. And just a little reminder that at the end of this session, you'll receive a quick feedback form from ourselves, and we'd really appreciate if you took the 30 seconds or so just to fill that in. It all actually helps us sort of provide the best content that we can to you here from Admirals. So without further ado, why don't we switch to the charts, on the slides, and let's crack on and talking about candlesticks for beginners. Okay. Let's hopefully bring this up. Come on. There we go. Excellent. So as I said, I hope you can hear me. I hope you can see me, and I hope you can basically see the slides. Here we are at Admirals. All right, a global Forex and CFD broker, but with local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and giving you the opportunity to engage with markets using MT4 and MT5 platforms. If you have any questions about Admirals, get in touch with your account representative and they will be very happy to help you. Also, we're still running Admirals Trades Days. This is an opportunity for you to basically get rebates on your trading commissions and spreads. If you look at the Admirals website, you'll be able to find greater details about this, or alternatively, get in touch with Admirals and they'll be very happy to help guide you. So what are we going to talk about today? We'll talk about, how do we get to using candlesticks, all right? Where is it? Where do we come from? How do we utilize them? What can we do to make the best of them? I'll talk a little bit about the history behind them, but most importantly, of course, for you, we'll talk about, well, how to use them in your trading. And what we'll do then is at the end of the session, if there's time, we'll switch across to the Admirals platforms and we'll have a little look at some candlesticks on charts, because I appreciate that it always helps to be able to, once you've had a little bit of education, to see how it basically fits in terms of the real world picture. Those who don't know me, my name's Paul. I've traded for many years. I've traded for funds, for clients. Primarily, I look to focus on trading FX indices and commodities. For long-term trending, or I'm a trend trader, and for shorter-term trading, I'm a reversal and mean reversion trader. Thanks, Yanis, for joining us. Thanks, Vasilina. Great to see you here. Great to see so many people here, joining us. It's always a pleasure to see. I always appreciate that we have a very global audience, even though this is the English-speaking webinar, we have a global audience, You're all very welcome. We here at Admirals hope you're all safe and well wherever you find yourself in the globe these days. We also appreciate that, we have a broad range of experience for people joining the room, and so we appreciate there's people who are complete beginners and also people who've had traded for a good while, and there will be something for everybody in this session today. But as I said, we are going to mostly focus on what can help complete beginners understand candlesticks and how to utilize them in their own trading. So I suppose what would actually be useful and helpful is to, for the people here joining us today, is to understand what, if any, experience you have for using candlesticks in your own trading. Maybe you're a complete beginner, and you're completely new to it and you're not really sure what it is. Maybe you've been experienced for a while and you've been using them, maybe you found, how you utilize them well yourself. So it'd be great, as I said, just pop a note there in the chat box, let's hear what your own experience has been, and I will, of course, be sort of sharing my own experiences, having traded and used them for a good few years indeed. So just try and move this out of the way, get ourselves set up there. Excuse me. So Vaseline says she's pretty much new, and that's absolutely fine, Vaseline. That's why these sessions are on, to help beginners understand candlesticks and actually how to trade them. And as the slide says there, ladies and gentlemen, it's easy for beginner traders to be intimidated by the amount of knowledge required to be able to analyze markets. However, with some education and understanding of how candlesticks are formed and what they tell us, then it becomes easier to analyze and understand markets. So in this session, we'll discuss how a beginner can understand candlestick charts and where they fit into the scope of trading financial markets. So it is a case of that, as I said, lots of new traders, lots of beginner traders, it's very easy for them to become intimidated by the plethora, of indicators and chart types and trading systems that are out there. And actually, normally when you're just beginning, what you're looking to do is just actually looking to learn the basic building blocks of what's required to be a good trader. And there are lots of people who will trade just literally using candlesticks themselves. And what we'll do is we'll look at where they come from, how they're formed, what they give us, and actually how you could basically just use a couple of simple ones to help give you a simple start, a simple start to trading financial markets simply with candlesticks themselves. So let's start with a very, very simple, the most basic of elements. As I said, we're going to focus just to begin with mostly, for just what is for a complete beginner. What is a chart? The truth is most private traders are utilizing charts to make their trading decisions. So they are effectively what they're using is technical analysis. All right. And part of that is, you're using a chart. A chart will show you the various prices which an instrument has been traded at over a period of time. That's at its most simplest. That's at its most simplest element. Some people like to use fundamentals. Some people like to use sentiment. Most will use a chart of some sort, but not all charts are the same, ladies and gentlemen. There can be varying degrees of difference between them, and it's about being able to understand and utilize them to basically that will help you, learn basic today, so growing trading, which is what we'll hope for when it comes to the series. So let's have a look at the kind of types of charts that traders will utilize. The first one is a line chart, which is available on both the MT4 and MT5 platforms. But as the slide says, a line chart is just a simple line chart, drawing a line from one closing price to the next closing price. That's the important thing. It's gone from one closing price to the next closing price, and as it said, when strung together, it forms a line. And so with that, you can see the general price movement of a currency pair or any instrument over a period of time. And that is effectively, just an example of a line chart for the euro dollar. But in terms of being able to see it and actually how to utilize that becomes quite difficult for us. It doesn't really tell us enough information to be able for us to really make good, strong decisions. There are times and places where line charts can help us, all right, and that we'll cover that in let's say an advanced intraday trading session. But for today, we're just going to basically progress for complete beginners. This is what a lot of people will see, when you open a paper, all right, if people still do that, or when you see on the news, if you look on financial TV channels, when they have a chart up, it's invariably just a very simple line chart, and, there's a bit of a squiggly line there. But in terms of for real traders, in terms of actually being able to help us and give us a great deeper understanding, of what's going on in that market, it's very limited indeed. What we move on from line chart is what you'll hear traders call as a bar chart, all right? And as it says there, a bar chart is a little bit more complex because what it's doing is it's starting to show you the really important information that all traders will come to sort of live or die by. The OHLC open, you've got the opening price, the closing price, as well as the highs and lows. The bottom of the vertical bar indicates the lowest traded price for that time period. The top of the bar indicates the highest price paid. And the vertical bar itself indicates the currency pair, but I'm talking about currency pairs, but it could be indexes, it could be individual equities, it could be commodities, it could be crypto. It doesn't really matter in that sense. The horizontal hash on the left side of the bar is the open price, and the right side horizontal hash is the closing price. And once again, there's that same kind of chart, but now it actually is giving us as a bar chart. Once again, it's just giving us a little bit more information. And as I said, the really key element for us is you're starting to get 4 little bits of data that become very, very important for traders who are using price action and technical analysis. OHLC. You want to know what's the open price of that instrument, what was the high price that it traded during that session, what's the low price, and what is the close. And actually the relationship between all those 4 bits of data, that becomes in itself interesting, insightful information. Okay, and the better you're able to read that and understand it, the better your understanding of the markets will be. Okay, and this starts to become very, very important, especially when as we go down later into the slides. And I've got a couple of examples of particular kind of setups that might be very useful for a beginner trader to start with. So, and then finally, what we have are candlestick charts. Why are they called candlestick charts? Well, because invariably what they were known as Japanese candlesticks, invariably they were used, hundreds of years ago, actually by traders of rice, hundreds of years ago. And invariably what would happen is, as the as the slide shows, is that they are drawn and they look like candlesticks. And it's the same bit of data, open, high, low, close, but how it's represented is what starts to give us just another level of psychological insight into what's going on in that particular chart. So if you'll see on most people's candlestick charts, if it's something like a green candle, maybe blue, all right, well then what we have is that that is a green bar. That's because price closed higher than it opened on this bar. Prices went up during that session. They went up and they closed higher. Okay. And on the flip side, when you're seeing red candles, all right, what you're seeing there is the fact that basically the price closed lower than it opened on that particular bar. Prices went down. But as I said, it is still that open, high, low, close. It's still those 4 bits of data that are the important elements. It's just how they are presented to us. And once again, once you start to learn to read those candlesticks, it starts to make things just a lot clearer, a lot easier to interpret what is actually going on underneath in the market. So, there's a chart. That's actually a chart of gold on the monthly. Okay, just on there. There's nothing else on there other than the candlesticks. As you said, the green ones are bullish candlesticks which closed higher than they opened. The sort of red ones are the bearish candlesticks which closed lower than they opened. But if you're completely new to trading, you might be looking at that and sort of still a little bit struggling in terms of how to interpret that. And the way I kind of tell people is, it's a little bit. It's a little bit like if you're a child at school and where you may have started to learn music. When you're learning about all the different notes of music, it's hard to sort of interpret them. And when you're looking at a sheet of music, it's just a line of squiggles on a paper to begin with. It doesn't really mean anything to you. And that might be the way that you look at a candlestick chart to begin with. But it is as you practice, okay, is as you learn to understand what each of these individual candlestick signals are, how they operate, that in itself is what starts to turn, what turns that sort of sheet of squiggles in a paper into a beautiful piece of music, all right? And it is the same with candlestick charts. Namely, the more you practice looking at them, seeing what it's telling you, all right, the better you'll be able to analyze your market, the quicker that chart will be able to sort of, your chart be able to sort of make use of it and actually utilize it. If there's one bit of kind of advice that I can give you as a trader, is that the market is always communicating to you. Right, it's always communicating to you, right? It's always telling you what it really wants to do. What it is that it is your job to get in alignment with the market, right? It's not the market doesn't get in alignment with you. It is your job to get in alignment with the market. And one of the ways you do that is by being able to read a candlestick chart and be able to interpret what the market is doing and what it actually wants to do, because that starts to give you the opportunity to put yourself in a position where you might be able to make more favorable trades. So let's look at, how do you kind of, read a candlestick? How exactly, what does it mean to look at a candlestick and to be able to read it? So in this picture on the right, what you've got is what's known as a classic candlestick pattern, a hammer. It looks like a hammer, doesn't it, ladies and gentlemen? All right, let's not get terribly hung up. I'm not actually too worried how you label it, because there's actually a few names for it, but many people would call it a hammer. What is more important is understanding, well, what happened in the market to cause that. Okay, what actually happened? And what we can see here is that, let me just try and bring up my the drawing tool here to try and help us, is the market opened here. Okay, that was the open. Okay, candle opened, and then at some point, for whatever reason, maybe it was news, maybe it was formal news, maybe it was some news of a geopolitical event came out, maybe there was a piece of economic data, maybe there was a political statement. Whatever happened, that candle opened, and then basically at some point during that session, the sellers took control of the price and pushed it lower. Right, that's what's going on. The sellers had took control of the price, pushed it lower, and probably many traders were selling the market. They were shorting that chart, thinking it was headed lower. However, at some point, okay, here, what we saw is that buyers stepped in. Now, why did those buyers step in? Maybe it's because they thought it was a good value, it was a good price. Maybe it hit a support level. Maybe it did a Fibonacci. There's a whole host of reasons why. Okay, sometimes it will be very clear why the buyer stepped in. Okay, sometimes it won't. All right, and that's the way trading is. But it is just, you need to just be able to understand that. Okay, at some point the buyer stepped in, and what happened is that they sort of drove prices higher. Right, they drove prices higher, and basically to the extent where not only did price basically past the where it opened, that actually it went higher, and it actually closed right at its highs. Okay, right when that market closed, it closed right at the high. That is in particular a very bullish signal. Okay, that is a very bullish signal. The market has communicated to us that actually, for the next session or two, it is more likely, the probability is that it's more likely to go higher, and so we would be expecting price, over the next couple of sessions to rally. It could dip down a little bit. It could dip down a little bit first, but we're generally expecting it to basically to rally. So this is the thing where it becomes important to us, because as I said, the market is always communicating to you. It's always telling you what it wants to do. It's always communicating to you. It's your job to start to learn to understand what it's actually telling you. Now, of course, that doesn't happen overnight. You have to practice a little bit, but like anything, practice makes perfect, doesn't it, ladies and gentlemen? And as I said, a lot of these have Japanese names. Okay, they have Japanese names, or they'll have westernized names. I'm not entirely too worried about how you label it. Okay, what's more important is I want you to just be able to read and understand what has actually happened here, what has happened here, what has gone on here, because as I said, the market is communicating to you, and you need to get in alignment and understand what the market is trying to tell us. So here's a little simple test. Okay, we're going to do a little simple test here, right? Is that namely, who wins the battle? All right, for this particular candlestick, who wins the battle? When that candle completes, who has won the battle? Is it the buyers or is it the sellers? All right, at this particular moment, that's all I want you to recognize and take on board as a complete beginning trader. But if we look at it, that first candle, it closed higher than it opened. It's a green candle. The buyers are in control. Okay, so we've got a hint of the buyers are in control. Next one, very clearly, the sellers are in control. It closed lower than it opened. Even in this one, this is, the sellers. Remember, the sellers closed the bar lower than it opened. It was a red candle. That means the sellers are in control. As opposed to the next one, where the buyers, it's still closed higher than it opened. So the buyers are in control. Now, of course, what will happen is as you start to learn to understand these candlesticks, you'll start to learn to understand that they have nuances, right? And you understand the kind of understanding the psychology of it, which we'll touch on at the moment. But first, first things first, we just want to make sure that you know who's in control. When this candle closes, who is in control of that market? The next one, it's sellers. The next one, it's buyers. Big strong candle closing on the highs, closing green. Buyers in control. as I hear, the buyers are in control, sellers are in control. Here, it is closed higher than it opened. Okay, the buyers are in control. Whereas here, even though it looks like the same pattern, it closed lower than it opened. Okay, so the sellers are in control. All right, there might not necessarily be a strong sellers in control, but that is where the session ended. When we start to see candles like this, okay, sort of dojis, it's still those sellers in control, whereas actually that is a draw, okay, and that's what people would call a proper draw, okay, a proper doji, namely where basically the close price and the open price have closed, they've been at the same price, and that normally means it normally means balance, okay. Doji is it's an indication for balance. The market is in balance at that particular time. But that in itself can be very useful because, things rarely stay in balance, certainly, for a long time, certainly not in markets, ladies and gentlemen. And that is the way we look at it. So when it comes to candlesticks, what we're interested in is candlesticks are easier to interpret, okay, because they just give us a little bit more information, okay. There's a little bit more color, all right, to it, which basically helps us build a landscape, helps us build a picture. Candlesticks are generally easy to use. They provide you with psychological insight to understand what's going on in that chart, and they're good at identifying possible market turning points. And this, ladies and gentlemen, this is a crucial point for you to take on board and hear. Candlesticks are generally reversal patterns, okay? The good ones are generally reversal patterns. So they are only really at their most useful when there is something to reverse. So it's only when we start to get to the end of trends that candlesticks actually come into their own properly. You will see lots of candlesticks in ranges of consolidation, okay, in elements of where markets may be range bound, but where it actually comes into value, where they actually are at their best, is that as reversal bars at market turning points. That is where they come into their most useful elements. And if there's one thing you remember from today, please remember that, because that will actually help you, an awful lot when you're doing your own analysis, to realize that just because it might have very nice like a hammer pattern, etc., or something like that, is that you have to put it within the context. We don't trade within a silo. What you're looking at, and as certainly as you grow in experience, is that you're not looking in just a one candle in a silo. It is the context, okay. It's a picture of where does it show up, right? What is it actually doing? What are the candles around it like? And that all starts to go together to help us build a picture from our own analysis, and that helps us make a decision. And it's one of three very simple decisions which you'll have heard me talk about plenty of times. Am I a buyer? Am I a seller? Or do I sit on my hands? That's it, really. Those are your three choices, okay. And what you're looking to do is, when I get certain candlestick patterns at certain turning points, well, that is probably going to give me an idea that there is a higher probability that the market is going to move in one direction over the other, and that's what we're looking and waiting for. So just a quick recap before we start to look at some specifics is that, remember, a line chart, okay, is very, very basic. It doesn't, it just connects the closing prices. It doesn't really help you massively. A bar chart is more useful. It's a bit more complex because you're getting the OHLC, open, high, low, close. All right. But finally, it's a candlestick chart, okay, because it gives us psychological insight as we learn and talk about, and we're going to talk about some specific ones in a moment. So let's look at some very popular candlestick charts and look at how they can be utilized and helped for us for our own particular trading. So the first candlestick that we're going to look at is what's called the inside bar. Now, as the name implies, an inside bar is formed when the high and the low of the bar is fully within the range of the preceding bar. Sometimes you'll hear preceding bars, they're referred to as a mother bar or a kangaroo bar. But what I want you to think of it is, I want you to think of the market and think of those candlesticks as a bit like an organism breathing, okay? Organisms like humans. We surge, then we rest, then we surge again. And when it comes to looking at markets, the inside bar is the rest. Market has surged, now it's resting, and what we're looking to do is to get ready to trade it on the next surge, the next move that will happen through there. That's it. As traders, we're just looking to catch that next particular surge. That is our aim, and that is our focus. So it's a couple of examples here, okay, for inside bars. Let's get the old drawing tool. The important thing, as I said, remember, is that this candle, okay, the high and the low of it is completely wrapped up within the preceding bar. That's why this candle isn't an inside bar, because actually at some point it traded higher than the preceding bar's high. Okay, that is not an inside bar. Some people try to say that, oh, well, it is, because actually Paul, the body was within inside the range. But you know, I believe that you should use all the bar. Okay, that basically, you know, if the bar here, as it says here, is the high and the low is here, that is because the price is traded at that particular level at some point during that session. That means it is valid information. Okay, it's valid information. And that means, you know, an inside bar, it should be, the range of the high and the low should be within the range of the preceding bar. That is what makes the difference. Okay, that is what makes a much bigger difference to us. So that was the inside bar. Let's have a look at the opposite, which is not unsurprisingly called the outside bar, or the engulfing candle. And an outside bar is formed when the high and the low of the bar fully engulf the range of the preceding bar. And it must include the complete engulfment of the entire range of the previous bar, not just the body. Engulfing candles don't happen as often as we would like, but when they do occur, they can be very strong signals. And outside bars provide traders with a clue to the next possible move. And what we normally will see here, let's get the old drawing tool, I've got it on another chart, is we'll see price maybe has been making its way up there, okay, in a messy trend like that. And then what we see is, as I said, is a big bearish engulfing candle, okay, which completely engulfs, okay, completely engulfs the preceding candle. And what we're expecting, okay, is that the higher probabilities are that price will trend in the direction of the close of the engulfing candle. Just think about the psychology of what has happened there. Price has been, perhaps it's been bullish, it's been bullish, it's been bullish, okay. You know, this candle closes, right, it's closed higher than it opened. And the next candle, for whatever reason, the sellers, the bears have stepped in, okay, and basically have absolutely wrestled control, all right. They have completely and utterly wrestled control of that market. The sellers are in control, and they have that big candle there. And then, so what we're expecting is there is a higher probability that price will fall in the next session. And as opposed to the opposite, where, you know, in this particular case, what you probably have seen is invariably price has been coming down, right? It's been a downtrend. And then what we see is the bulls, okay? For whatever reason, maybe it's a level of support, maybe it's a big round number, etc. Maybe there's some economic news, doesn't really matter. What happened in that session is the bulls stepped in, they wrestled control of the market, and they took prices all the way up, okay, to you know, until price completely engulf the preceding candle. And with that in mind, what we're expecting is that there is a higher probability that price will invariably move higher over the next couple of sessions. And that's what it is. It's just giving us an indication of what is a higher probability move. A higher probability move in that sense is to see basically price rise its way up over the next couple of sessions. And there's a few examples, more examples here. Bullish engulfing candles, where price will have undoubtedly come down. And then, as you can see, you know, there's a complete move there, okay? Completely bullish engulfing. It is completely outside the other preceding bar, as is here, okay? We're just seeing that. Remember, what we look to do is when you see that, you're looking to trade in the direction of the outside bar. And normally, to begin with, for complete beginners, your stop loss should be the other side of the bar. And here, you know, these are a couple of bearish ones where you're probably expecting to see price rally up and then basically put in a big, strong, bearish, okay, outside bar and bearish engulfing candle. And actually, we suspect the probability is that price will start to move. Remember what I said a few slides ago, ladies and gentlemen. Generally, candlesticks are reversal patterns, so they need to have something to reverse. They're only at their most useful when you see them at the end of trends. That's the important thing to take on board, ladies and gentlemen. And then what we have here is, well, there's actually a lot of names to this. There is the pin bar. It's sometimes called the pin bar, sometimes called the rejection candlestick. Sometimes you'll hear it called as a shooting star or a hammer, etc. As it says there, even high tests or low tests. Okay. As I said, I'm not entirely worried how you choose to label it, and whatever label sticks, the easiest with yourself. But what is important is the understandable what actually had to happen to complete that rejection candlestick. And this is where it does become important to us, okay? This is where it does become important, namely that we have a good pin bar should have the open and close, okay, the body within the range of the previous bar, that actually the candle wick, okay, should be 2 to 3 times, okay, the size of the body. Okay, that's some poor drawing there. And then what you'll find is that you're expecting to have a long nose protruding out from all the other bars, and the good pin bars, they stick out and are very obvious. So these are, you'll see a good deal more of, certainly much more than you'll see engulfing candles outside bars. You'll see quite a lot of this, but just remember, ladies and gentlemen, okay, just remember that kind of adage that candlesticks are reversal patterns. We need to see what it's going to reverse. Okay, that is what is important. That's what's really important to us. So, what we might see here is, these are what we termed as bullish pin bars, is that prices will have undoubtedly come down. And then what's happened is during that session, remember, price has been pushed down, buyers have stepped in, they've pushed it all the way back up, and it's closed okay on its highs in that one. And even this one, even though basically it's closed lower than it opened, you can still see that there was basically, as price went down, it got reversed and pushed all the way back up. The buyers, the buyers are sort of starting to take control, and we'd be expecting, okay, ultimately that basically we have the probability is that price will probably move higher. And even this is like a doji, because price closed and opened at the same time. Some people would call this some people would call that a gravestone doji. Some people would call that a dragonfly doji. As I said, I'm not entirely worried about how you label it. It's more about understanding, that what has gone on psychologically. That is actually the sort of the key elements to us. And on these being bearish, namely price will have been rallied up, and then at some point during that day, price got pushed all the way up, and then as it came back down, okay, effectively, it created that pin bar. And even though the sellers have, in control, all right, what we're expecting is that price will probably likely fall the next day. The prior probability is that it'll fall. And if you want a very simple way to understand it, and it's one of the reasons why they're sometimes called pin bars, is that if you think about, the wick of the candle is a bit like the nose on the Disney character Pinocchio. Okay, whenever Pinocchio told lies, his nose got longer. And think of it like in that sense. Okay, is that wherever the wick is pointing, okay, in this case, wherever the wick is pointing, the likelihood is it's pointing in the wrong direction, because we're expecting the price is more likely to go the other direction, and that's what we look to work on. That's what it is when we look at pin bars. So, in conclusion, price charts give us an indication of how the price has developed over time. No real surprise. And whilst you can use line and bar charts, generally I tend to find candlesticks are much more useful, because not only are they telling you that OHLC data, but they also provide psychological insight into the state of the market. They're telling you, giving you a much clearer idea of who is in control of the market at the time. But just remember that candlestick patterns are reversal patterns. That's the important thing, okay? And as you learn each candlestick, you'll be able to combine them to create trade setups. What we've done here is we've just shown you just individual setups, which we're going to look at on a chart now, just to try and put it into some context. As always, we ensure and recommend that you use good risk management practices when we look to trade them, right, which we'll talk about on the charts. And yeah, we've got a few minutes left, so why don't we have a little look at them in live markets themselves. So if you have any questions, you can always contact Admirals. All right. Okay. Remember, you can see that admiralsmarkets.com is the website, global@admiralmarkets.com. If you want to email them, maybe you've got questions about this particular session. Maybe you've got questions about other sessions that we can do. You can always get in touch. And this video, okay, along with all of the rest that are created by my colleagues, Marcus and Jens, will invariably be seen on the YouTube page at Admirals Global, and also on the Facebook page, Admirals Global itself. So I hope if you're a beginner, it's just giving you a little bit of help, a little bit of insight into, what Candlestick is and how it actually basically is formed and what we're looking for. But if you bear with us a moment, what we'll do is we'll switch across to the charts, the Admirals charts, and have a little look and a chat through, okay, how it's showing up on live markets at the moment, because I appreciate that will actually always give you a little bit further insight. So just bear with us and we'll switch across. Let's bring up some charts. Excellent. Okay, so here is this is the Admirals MT4 platform. You'll just see it's very simple. This is my dollar profile. Okay, and we'll have a little look at a couple of these charts here and see what we can particularly see. So this is just mostly charts of the US dollar against other currencies. So I've got Australian dollar here, pound against dollar, dollar against Swiss franc, euro against dollar, Kiwi against US dollar, dollar against Canadian dollar, dollar against yen, and the overall dollar index there as well. So the idea being that it gives me a very, very quick understanding and insight into the overall dollar picture whilst I'm looking at trading. So let's have a little look at what have we got here. Okay, on the Aussie dollar, I'm going to try and use a few different basically time frames and instruments just to give you a little bit of insight, okay, for this time that we have here. So this is the Australian against the dollar on the monthly chart. Okay, that's what it is. So big picture. You might not be trading this. You might be trading much smaller time frames, but it's it's good. It's interesting to know. Okay, what has been going on, and if we just basically have a little look at what we can see here. Remember, what we're saying is that candlesticks are about reversal patterns. Okay, about what we're looking for. So just looking at here, price had moved up to what was the 80 number. Okay, the big round number. Hopefully you might be able to see that on the right of the chart there. Okay, a big round number, 80. Okay, or 8 all the zeros. And what had happened is price had printed there. Okay, price printed a bearish pin bar, and price did for the next couple of months went down. It did come back up to form a double top before it actually continued on its way down. There, this was actually the low. This was the low form. This would have been the low form based on when the markets went a little bit crazy during the initial COVID lockdown. And then what did it print next? Okay, after that, there was kind of a big pin bar there. It actually printed next. It printed an inside bar, a bullish inside bar. The market had surged. Now it was resting, and we were getting ready for the next surge. And very often is the case that it surges in the direction that it closes on an inside bar, and that's what happened. Price, we can see price ran all the way up there, just basically there we go. Price ran all the way up there, back up to that 80 number, big round number, and then what does it print there again? Okay, it prints a pin bar. Okay, and even though it was a bullish close, remember what we just said, the wick is like the Disney's character Pinocchio. Which way it's pointing, okay, is the opposite to the way it goes. And what we see is that after a couple of months, price folds its way down there. So that just very simply there, okay, we've just there's a couple of pin bars, a couple of inside bars, okay, there that invariably we can look at, okay, and that is just about on a monthly chart being able to understand that, and it helps, as I said, you want candlestick patterns to give you a reversal pattern, but also as you grow as a trader, right, you'll be looking to see what that happens, okay, in terms of when you see these patterns occur, at things like big round numbers, at support and resistance levels, whether they be horizontal support and resistance levels or whether they be dynamic support and resistance levels, something like moving averages, or which are, they are beyond the remit of this session. But if you go onto the Admirals YouTube channel, you'll find that there are a few videos on there that will give you insight, okay, into how to utilize these with moving averages themselves. So that was just like monthly chart on the Aussie dollar. Let's see what else we've got here. We'll just do another chart and stuff. Just as I said, we've got a couple of minutes left, and hopefully it helps just to basically see when you see them on the charts themselves. Pound against US dollar. Okay, this is interesting. This is a 4-hour chart once again, and just 1 second here. Vasily says, yes, my pain. Okay, so you've, has that been your pain trying to understand them in the context of live markets? I take it, Vasilina. So hopefully today helps you a bit. So what we've got here is, this is the pound against the US dollar. This is the 4-hour chart, and I want you to just look at this. See how once again there's what we call a big round number, 1300, 130. Okay, plenty lots going on there. No, it's the pound down. Right, okay, the pound going down. Well, yep, the pound has been going down, and let's talk about what are the ways that you might have been able to understand that. Well, what we could see is that the price had been trending down for a good while, and here is the first time it hits the 130. What does it do? It puts in, that is a bullish pin bar, okay, right? So they think the market is actually going to go up for a bit. It actually goes sideways, but then it prints another one. Here we go. There's another big wick there. Okay. People think the market's going to move up. It then here prints a bullish engulfing candle. Okay. And then it goes on a couple of days and then prints another bullish pin bar. So there's kind of lots of bullish pin bars, engulfing candles there before price pops its way up. Okay. The 130 level has acted as support. Price goes up, but it can't get any higher than that 200 period moving average. And what does it do? It comes back down to that 130 level, but this time it's not as strong. Okay, it's not as the sort of the break off it is not as strong. Okay, price does bounce up a little bit, but it doesn't bounce as high. And actually, once it's gone up there a little bit, there's lots of wicks there. Okay, sorry, just apologize for my drawing. And what's happened is the price is getting squeezed. Okay, we've got the sort of 130 level underneath. We've got the 200 period moving average above. The price is getting squeezed. We can see that the wicks, okay, which there was quite of here, lots of strong wicks. Okay, just I hate using a trackpad. Lots of strong wicks there. Okay, pushing up. They weren't there here. Okay, and in fact, actually, what they were is the strong wicks were to this side. Okay, all the strong wicks were pointing to downside, and then what we saw is actually once price did break. Yeah, it broke and it ran very, very strongly indeed. Okay, it ran very, very strongly indeed, and it's come all the way down to the kind of 125 level where it's just pivoting around there. Okay, that's what we saw on there. That's what we saw on there with the pound against the dollar. Just let's see. We can actually have a look at Kiwi dollar here because Kiwi dollar has been in a super trend there. Let's just for the last minute or two, we will just basically, here we go. So what we had here was, let's get the old drawing to is, price had been in a nice uptrend here. Price had been a nice uptrend. It hit the 200, put a pin bar, bounced up, and then basically, what happened is we had from this level, we just basically would create a little bit of a level there. And then what we had here was, hopefully you can see that there. This was kind of like it's a bearish pin bar, all right? It's a false breakout. Okay, price had pushed higher, but it couldn't, all right? Because basically, here we go, it pushed higher, but it couldn't stay higher. It couldn't stay higher at all. It pushed up, then it got pushed all the way down. And then what we saw is that actually price just started to collapse away from there, all right? It collapsed away. And that's where, as I said, remember, pin bars and candles candles in general, they are reversal patterns. So there needs to be something for it to reverse. They hold more validity when you see it at the end of a downtrend. Just, you know, end of an uptrend or an end of a downtrend, at the end of a trend when it needs to reverse, that is what you need to take on board. So there you go, ladies and gentlemen. I hope that has helped you. Okay, if you're a complete beginner, hopefully there's just been a little bit of help and understanding in how, what a candlestick is and how you could utilize it in your own trading. As you grow, okay, and experience, as you practice it, your analysis skills will become much better. And then what you'll also do is, you'll start to learn to see how you can utilize them as part of a trading plan. And in particular, what we like to see is a confluence of events, okay, where you start to have 2 or 3 things happen together. So a little bit like what we saw in the charts there, okay, in terms of, sterling bouncing off 130 before it dropped, at its way, or basically even just, Aussie dollar, bouncing off 80, or even the Kiwi dollar, okay, just having a false breakout there before it rolls over and reverses. So it needs to be, remember, candlesticks need to, need to be something there for it to reverse. That is when they actually have their own particular power. So I hope you found that useful. As always, I wish you the very best of success in your own trading endeavors, and I look forward to speaking to you soon. Until then, trade well, everybody. Cheers.